First rates and it's a flat start. Can you imagine? I mean, a 17,000 index has a 2-point change. Neither here, neither there. The small cap index, 0.5%, not even 0.5%. Small cap index is now up 6 points. The mid cap index not going anywhere. I mean, this is almost like saying that there is just no price action. Nobody's just interested. The premium has collapsed. Volumes are dry. Retail activity has got completely subdued. The breadth of the market is not looking meaningfully better, but breadth of the market is looking slightly better. Accenture numbers. First thing, let's capture that for you. Large cap ID. TCS, Infosys, Wipro, and HCL Tech. Wipro, BFSI play up. TCS, BFSI play up. HCL Tech, Wipro is not a typical BFSI play, but Wipro has got their own set of challenges. HCL Tech, BFSI plus infrastructure management service, both of them put together, the reaction I think is solid. Tech Mahindra is not a BFSI play like Accenture, so it is rising the least. So tech is off to a good start. Tech is off to a cozy start. FinTech now and consumer tech. Zomato, Paytm, Policy Bazaar. I think there's a big upgrade on Policy Bazaar by one of the foreign brokerages. And there you go, Paytm, FinTech, Zomato. None of the stocks are giving IT stocks a company. So take idea of the equation, Aisha, nothing in the market again.
Yeah, IT really is the one which is hogging all the limelight this morning. So that is looking good. Let's see what else is, if at all there is anything. HAL, is it seeing any rebound after yesterday's breakdown when the OFS got announced? That stock has made a move of about 1.5%, although it fell a much larger quantum yesterday. It was down about almost 5.5% or so. BEL as well, they've backed 2 contracts from the Ministry of Defence worth about 3,800 crore rupees. So that is another stock which is in focus. Lupin, they've got a tentative approval from the US FDA for one of the acid tablets. So let's just see what that stock as well is up to. Vedanta board meeting on March 28th for a 5th interim dividend. Campus Activewear, we just reported to you that TPG, I beg your pardon, is looking to sell that 7.6% stake via block deal. The floor price has been set at 345 rupees per share. That, of course, is what sources are indicating to us. Campus is down 5.6% as we speak right now. What are mutual fund companies doing? The few ones listed over a 3-year debt mutual funds won't get indexation benefit. That's the finance bill amendment proposal, and that's the space, Nikunj, which is really bleeding this morning.
Yeah, I mean, you know, as it is, things were tough for them, and now things will get tougher. So, the large part of the institutional debt holding and HNI investors who've always decided to invest in the debt schemes because of the indexation tax advantage, that arbitrage is over now. Compulsions and asset allocation models will not change, because when you are doing asset allocation calls, at least in the debt market, tax considerations are important. With equity, that consideration may not be there because they're different asset class. But for debt investors, I think at least for fixed income investors, that's very large. Now, why Motilal Oswal has not fallen? Well, simple. They don't have a very debt portfolio. Anand Rathi Securities, well, if money moves back to equities, they'll get more commission. UTI MC, large debt exposure. Birla MC, large debt exposure. HDFC MC, very large debt exposure. So all that is moving in a classic manner, so to speak now.
Yeah, it really is. HDFC MC is taking a whack, 4% lower for this one as we speak right now. But Kunal, given that nothing's happening on the index once again, what are the first trades you're executing?
So that'll be ITC. I think that stock still looks quite strong, more formidable at the 375 to 80 zone. So that's a stock which I look to buy. My expectation is that the stock would probably come back towards the previous highs of 394 to 400 over the near term.
Nooresh, what about the first trades that you're punching in?
Still playing defensive, trying a bounce on NTPC at 174, 175.
Srinivas Rao joins us now. Let's connect with him to understand the construct of the market, how he feels that interest rates and the macros are moving. Srini, good morning. Thank you for joining us. Srina, let's address something which has come more like a bolt out of the blue for all of us. The amendment to the new tax bill. Now, what we're debating from the morning, what it means for fixed income investor and for the debt mutual fund schemes. Will debt schemes see a significant amount of slowdown or outflows after the new rules which will be applicable from 1st of Jan 2014?
Good morning, Nikunj. Thanks for having me here. Yes, I think this is a bolt out of blue, a surprise for us in terms of what has come. But Nikunj, also I think what one has to remember is, and it is negative, there is no doubt about it. But I think one also need to remember, if you see what has happened in the budget to the insurance sector, so they were making representation that it should be on par with at least the mutual fund debt schemes. So I think post the changes that have happened in insurance, so there was so insurance become relatively less attractive, and maybe we were expecting more flows into debt, and instead of that, we have this negative news, which is going to be a dampener for debt funds for sure.
So, net, if debt schemes will see more inflows, could that have an impact on the entire corporate bond market, on NBFCs, at the wholesale borrowing per se?
Overall, mutual funds are playing a relatively lower role in corporate bonds. I think given the focus of regulator on focusing on AAA or super high quality, I think to that extent, mutual funds have not played as much of a role that one wants to play in the corporate bond. So I think to that extent, even this is not so much important.
Markets. We've come on the right side of the Fed event. Commodity prices are down, rupee is stable, the macro headwinds are receding. But markets are not capturing that. If we ask anybody why markets are down, it is because of macro concerns. The macro concerns are getting addressed. The Adani fiasco is behind us. So if the concerns are getting addressed, why markets are not reacting to that? Why markets are not capturing that?
Yeah, Nikunj, I think it's a function of both in terms of what is happening globally and also what is happening in India. So when it comes to India, I think many things are getting addressed and things are in a fairly good position. But at the same time, Nikunj, if you see the last quarter results, I think there was a bit of a surprise or a shock for us on the earnings front. And quite a few sectors have seen a sudden slowdown in their revenues and profitability. So that was a bit shaken by the market. So one hand, we no longer have as much confidence on earnings growth that we used to have, let's say 2-3 months back. So that is putting some bit of a pressure. And add to the fact that, we've seen a steady outflow from FIs. And when you see this kind of a global news where financial sector per se seems to be in a fair bit of a turmoil, and in India, financial is the largest weight. So to that extent, I think market is grappling or struggling to find its feet in terms of why should market move immediately when you have A, global concern, and B, within India also, earnings growth visibility seems to have taken a hit at least right now, Nikunj.
Srinivas, I'm just looking at your recent opinion, and you've talked about as to how pharma is one of the preferred sectors along with banks. Banks, I get, yes, but why pharma? Is that a contract call, or do you genuinely see merit in this sector right now?
I would say pharma is a defensive bet. I think when I'm seeing so many uncertainties all around, pharma is relatively insulated from these uncertainties, where whatever happens in globally and domestic, the demand for pharma per se is relatively insulated. That to that extent, it makes it defensive. The second is also, I think, if you see pharma has, let's say, 3 drivers: domestic, US, and other markets. And within that, US has been a little bit challenging for last 2-3 years, given the kind of pressure they've seen in pricing. But our sense suggests that there is a clear improvement in US markets. So I think companies catering to US would see a decent growth in the coming quarter. So that also makes me to be more positive on pharma at this point of time, Aisha.
Morning. Just wanted to also understand what the key triggers are for picking out the domestic consumption space as a whole. Are there not worries about the looming inflation rate as well being a bit of a dampener for the sector going down the line?
Yes, I think consumption is a secular story in India, but at the same time, stock picking is very important, and quite a few stocks are fairly expensive. To that extent, I think stock picking is very important within the consumption space. So I am more comfortable with names where even the valuations are more palatable. Let's say less than 30, 35 times rather than paying 50 times plus. So theme is great, and I think yes, we are seeing in some pockets slowdown, but I think if it's a matter of 1 or 2 quarters, we have to live with it and look beyond that. I think to that extent, I'm fairly positive on the consumption story. I think the discretionary space also is looking extremely good. But I think stock picking is very important there at this point of time, given pockets of slowdown and also expensive valuations in certain stocks.
So let's delve a little bit deeper into that, Srinivas. Where within the consumption space, considering how large it is, do you actually find value right now?
The auto is one space we are positive right now. And also, I would say certain staples, I will not put all of them, but I think large liquid, but also diversified places where I think there is a value at this point of time.
Autos are a deeply cyclical sector, and frankly, we've seen that in last couple of years that you have to time your entry and exit in autos. Why are you looking at autos for a sector which, in a sense, has cyclical bent?
Nikunj, I would say within autos, we'll have to see two-wheelers, cars, and commercial vehicles as the three separate categories. And you're right in terms of saying that CV, commercial vehicle, is extremely cyclical, and the other two are not so cyclical. And we are right now more positive on the passenger car segment. I think that's where we are clearly seeing. I mean, today, if you see, it has become an aspiration of every middle-class Indian to own a car if he's not already owning. So from a two-wheeler to four-wheeler, I think that trend is very visible. And also, I think market has consolidated. So I'm more positive on the PV within this three segments, Nikunj.
How real to your mind is this entire EV, EV opportunity for listed players?
I think if you are looking at next 1, 2, 3 years, I don't think it is not real. But market is not just looking at the absolute number. Market is always looking at trend. To that extent, one can clearly see a shift towards EV, both in three-wheelers, two-wheelers, and passenger car. Though it is very, very small right now. But I think when we are paying a price and price to earnings of 25, 30 times to these companies. So what are we saying? We are not just saying for the current earnings, but we are also paying for the future earnings. So in that extent, if EV or a hybrid is future, if a company is not present in that segment, I think we will see a PE contraction. And similarly, if a company is making a lot of investments and moves to see that they are present in the future upcoming area like EV, those companies will trade at a premium. So to that extent, when it comes to price to earnings, I think EV is important, but thinking that they will contribute meaningfully or anywhere near meaningful in the next 1, 2, 3 years, I think we are very, very far from that.
Okay. When you say you like consumption, what do you like within consumption?
So as I said, the current GDP we are closer to $2,000. And from here, when you move up GDP, we will actually see people spending more on the discretionary. I think the food, the basics are taken care. You will spend more on travel. You will spend more on education. You will spend more on health. So I think this is where we will see incremental income that people earn would spend on. And that's what we are positive. Let's say one space is hotels, travel. I think these are the areas where we will see a higher than a normal GDP growth in terms of their own offline as well as earnings. Nikunj.
Appreciate your time. Thanks so much for joining in and giving us your take on the markets as well as your outlook on individual sectors. A quick check-in as to what the index is currently up to, 17,025. You've got the broader markets as well, pretty much lackluster or sideways, if you will. In terms of individual sectors, well, it's the banking sector, real estate, metals, a lot of those high beta pockets that aren't doing a whole lot. And IT on the flip side is showing you quite a bit of conviction in trade. So it's up by a solid 0.7%. And names within this universe, the large cap names along with Persistent, Coforge, Wipro, Infi, etc., they're all standing out in trade. But let's listen in to what Nilesh Shah, MD and CEO at Envision Capital, had to say. He believes that the current global situation is not as bad as 2008, and he does expect that India will give returns in line with peers this year. Let's listen in to that exclusive conversation.
So I don't think it's going to be worse than global markets. It probably could be that India would fall or correct or consolidate in line with global markets. And then after that, I think come the end of this year, the start of next year, 2024, you're going to see a huge outperformance coming in from India, because again, all the positives will come back, the world gets into a risk-on trade, and India is going to be the dark horse.
Okay. So let's divide the market in three time phases: 1 year, 3 year, 3 year plus. What looks good and attractive for 1 year, 3 year, and 5 years?
I think because from a 1 year perspective, the large caps look good.
Okay.
I clearly believe the
Buy the Nifty.
Buy the Nifty, or buy a basket of maybe 5 to 6 stocks in the Nifty, you know, and I think they all have come off on an average by about 25%, 20 to 30% from their peaks. Maybe the room for them to fall further could be 5 to 10%, because you can never say where the bottom is. But I think from a 1 year perspective, I think that pack will do extremely well. Okay, so I think from a 1 year perspective, I think that's the space. From a 3 year plus perspective, I clearly believe that the mid caps and small caps will essentially are going to beat every asset class globally and in India hands down. Okay. So I clearly believe from a 3 year plus horizon, I think mid to small caps look really well poised for a big outperformance.
5 year plus?
Hard to say, but I think 5 year plus, I clearly believe that in a bull market or an upcycle, the mid and the small caps will outperform. And this has happened always. And so if you ask me from a 5 year plus, again, it's going to be largely mid and small caps, which will do extremely better. Now, you could, when I say mid and small caps, it could also mean a bunch of stocks which today are probably hated, are large enough, but you know, you can't call them as mid and small caps because the capitalization is a bit higher. But for example, some of the stocks on, say, on the online side, you know, which had IPO'd in 21, I think from 5 years from now, these could be hugely profitable companies, and they could be a lot more valuable than where they are today. So it could be a set of stocks which are either hated today or are doing well but are still mid and small caps. So from a 5 year perspective, I think that's the pack which will do very well. I think the large cap IT companies will still kind of have that kind of growth.
8-10% growth is here.
8-10%. I mean, if I were to kind of just, and I'm taking Infosys as a reference point, even in the best year, which was financial year 21-22 for the sector, their earnings growth was only 16%. In your best year, you're going to grow 16%. Okay, so I think we have to keep that in mind, that they will probably just grow in a range of about 10 to 12%, depending upon how your operating parameters are. So I would still think that, and the large caps have played out. We've seen a huge rebound. So if we look at it probably sometime later, last year in 22, or the start of this calendar year, the IT stocks were on the lower side. I think we've seen some kind of a rebound trade. I think we're done with that. I don't think from here they can outperform in any significant manner, the large cap kind of pack. I think in IT, I still believe that the change and the delta, and therefore the alpha, will come in from the tier 2, tier 3 names, the mid to small cap names. There they have very interesting opportunities. Somebody's getting into a new niche, somebody's getting into a new geography, there are client wins, a new CEO, a new leadership team.
What do you like?
These are the kind, well, we own only 2 stocks currently. We own in fact only 1 stock which is called LTTS right now, and that's about it.
You've sold Tata Elxsi completely?
Yeah, we are out of Tata Elxsi.
Okay.
So we're going to be evaluating. I think we're going to take 1 or 2 more quarters. And I think in that environment, we will come up with extremely good ideas. But say a name like Tech Mahindra, which is large
The
cap.
change of guard there, yeah.
But I think there's a change of guard. Somebody with strong credentials is really coming in out there. It's got the pedigree of the M&M group. The group CEO of M&M has been very aspirational and is really driving individual operating companies really hard. There is a change in leadership for Tech Mahindra. Size is great. They have very minimal exposure to BFSI. They are in communications and telecom and all of that. So that's one company where we haven't invested yet, but I think we would want to be watchful. We would want to see what the new CEO has in store in terms of his aspiration, his strategy and all of that. We will see and we'll evaluate and maybe take a call there. So that's like one of the names which is part of our prospect list but is not yet in the portfolio.
But this is the lowest positioning in IT in your portfolio as a weightage?
Yes, absolutely.
You're supposed to be the IT guy.
Yeah, but I think
anything in IT, go and ask Nilesh.
I think in Nikunj in 21 and some bit of early 22, I think we had a lot of excesses in IT. Okay, I mean, look at the excesses that we saw in names like Tata Elxsi and Persistent.
60 times, 70 times.
I mean, all of that. Okay, and so I think the markets had priced in as if the margins that they were reporting and the growth rates that they were reporting will continue for very extended periods of time. I don't think so, because our IT companies are services companies. These are not product companies. Again, within technology, maybe some of the SaaS companies, we don't own any of the SaaS companies yet, but I think some of them also might look very, very interesting. Some of them have come off by 60% already, 50, 60, 70% has been a shave off. Maybe some of them become very, very interesting.
Shashank Srivastava joins us, Senior Executive Officer with Maruti. Shashank Srivastava joins us, Senior Executive Officer with Maruti, and we're going to be talking about a range of topics, but every time I meet Shashank, it's a habit now. I start talking about breakfast, bread, butter, jam. So Shashank, what was the...
We even talk about Filmfare Awards, by the way. He was right there in the first row.
Oh, I missed that. I missed that completely. Yeah. So I think Aisha wants to start with Filmfare Awards. I'll leave the breakfast menu for some other time, Shashank.
Why don't you talk of parathas also?
So Shashank, our obvious question, अब वो जो मारुति में हम बात करते हैं, that is the last time when we spoke, you said, look, the bread is toasted and the butter is not missing. So is the bread, butter and cheese in place now for
Parathas
Maruti?
with butter.
Parathas and butter.
Parathas are there. I think the butter, it depends on how much you want to put, depending on what kind of paratha it is. But essentially, there are some models where you have a long waiting list where you see very little of discounts, and that is good for the overall. They are particularly the larger cars. And then in the smaller cars, you still have an issue where the availability is much better. Although I would say in volume terms, those cars are also doing very well.
Just to do a channel check here, when we spoke to several car dealers yesterday and we wanted to assess and understand that how this entire festival season demand has been, Gudi Padwa in Maharashtra, a lot of festival demand which typically happens in South because of Navratra and other events. We get a sense that this time around it's not been a great festival season. Is that true?
Yeah, I would say, of course, the numbers still to come. Typically, the month-end figure, towards the month-end, the retails climbs up every month, irrespective of whether it is auspicious period or not. The auspicious period, of course, starting only recently. So I would expect a lot of retails still to happen by March end. The estimate in the industry is that it would be in the range of about 342 to 345,000, the total retails. And the wholesale is expected to be around that 330 to 335,000 range. These are by themselves a good number because they are a growth over last year, 3% for wholesale, estimates 2% over last year for retails. But yes, you are right. There is a sense in terms of the other parameters of bookings and inquiries that there seems to be a leveling off after some great quarters of consistent demand patterns.
You have already intimated that from 2023 April, which is next month, there will be a price hike. Yeah. You are increasing prices when commodity prices are down. Why is that? Shouldn't it be the other way around?
Listen, if you compare the commodity prices, what they were 2 years back, they're still very, very high. So I'll give you an example. Steel, for example, 2 years back was 38 rupees a kg. I'm talking of automotive steel. It went up to 84. It has come down to, I think, around between 66 to 68 rupees a kg. So you might say that, it has come down. But actually, when you compare it with 2 years back, it's almost double. The same goes for copper. Was $5,200 2 years back. It went up to $10,400. Now it's still around the $9,200, $9,300 mark. Same goes for aluminium and even the rare metals. So the thing is that while we have had price hikes in the past 1.5 years, but they have been very, very small. And the reason is for those small price hikes were because during the COVID period, manufacturers, including Maruti Suzuki, we were not sure how much would be the demand bounce back. As market leaders, we are very conscious of our responsibility that we are also in some sense responsible for the overall demand. And therefore, the increases in the prices that you saw were not enough to cover the commodity prices. So that is the reason why still, and that's the reason the profitability the last 2 years have actually come down for OEMs. The other factor is the regulatory requirements, which are changing from 1st April. The RD and the OBD2 norms means that there will be a spec changes in the engine of the cars, and that also is an additional cost. So these are the two main reasons why we have decided to increase the prices from April.
Right. So Shashank, I mean, we don't want to get this wrong. Are you saying that even with the RD norm implementation, there are going to be no more price hikes, at least in the offing from Maruti? Because a couple of your peers have already, hinted at a price hike come next month.
So we have said that in April we will increase the prices. That's what we filed in the stock exchange yesterday. So there will be a price hike. Only thing is that the price hikes will be different across models because it depends on what type of changes you require for meeting those RD norms. And remember, a lot of the models of Maruti Suzuki, we have already made those changes. And in fact, only a few models remain for us to convert to the new specs to meet the RD norms.
Okay, so just to understand then, in light of all of this, you spoke about the price hike, the RDE norms, etc. Any implication on what the margin picture could look like for the company?
Of course, I'll not be able to give you a forward estimate of what the margins would be. Obviously, if the cost structure as of now remains same, increase in prices theoretically lead to a better margin. But it all depends on how the costs move. And that includes, obviously, the material cost, which is about 75 to 77% of the cost structure of any auto OEM.
I've had the pleasure of tracking Maruti for almost 20 years now, and almost 20 years in its listed avatar. So it's not for the first time commodity prices have gone higher. There is a cycle which is at play. But Maruti in 2-3 years always has managed to come back to its long-term margin average, which is in early double digit. So can I safely assume that maybe not in this quarter, maybe not in the coming quarter, maybe next 2 quarters, but ultimately Maruti will go back to its long-term margin average, which is in early double digit?
I'm probably not the best person to reply to this question. It obviously depends on the competitive scenario, the strength of our models, how they're doing in the market, and also the general scenario of economy. So, but you are right. The entire organization obviously wants to get back to a higher level of profitability.
From a pure stock market standpoint, investors, they always look at the product pipeline, the launch pipeline, because that in a sense always act as a near-term trigger to generate sales and momentum. What I understand is that for 2023, Maruti has one of the strongest and one of its highest launch pipeline, right or wrong? True or false? You are the right person to answer this one. Margin one you avoided. This one you know the answer. I know it.
True, it's true that we have unveiled two very strong SUV products, the Jimny and the Fronx. We have had bookings, and we will start selling those vehicles sometime in April. The Fronx and Jimny together have got almost 40,000 bookings as of today, and that's a big foray that we have done into the SUV sector. The SUV segment is a largest segment now, and we were a little weak there. Our market share there was only about 11.5% last year. So we do hope to become the number one SUV player in this financial year 23-24. And you are right; it is a very strong product pipeline that we have. We now have 16 brands in the PV industry, in the PV market, as against 14 that we had earlier. And going forward in this year also, you will see a lot of new product introductions from Maruti Suzuki.
I'm curious to understand what the SUV portfolio in particular is looking like. I mean, the response to Vitara, Brezza, and I stand corrected, I saw you at the Z Cine Awards. So I also want to know about Arena.
Yeah, so there you saw the hot and techie Brezzas. If I can get into that sales and marketing pitch, the hot and techie Brezza actually is was in February the highest selling SUV in the country. So it does around 15,000 numbers a month, which is pretty good. It's in the compact SUV space, which is the largest segment in the industry. And we have bolstered it with two new products, the Jimny and the Fronx, which come in the Nexa channel. And of course, the Grand Vitara, which we introduced in September last year, it's garnered more than 130,000 bookings. And we are selling almost, there is a long waiting list, and we are selling whatever is available. And that is a good sign for the next year as we try to become the number one SUV player in the country.
Okay, so just to conclude, one final thought. SUV market, whether it's urban SUV or luxury SUV, that now accounts for almost 35 to 40% of the new car sales. Is that
actually, yeah?
No, is that number right or wrong? Because that's the number which has come to us from Mahindra and Mahindra.
Actually, the SUV segment is now about 43% of the market. Out of which the compact SUV segment is about 22%, and about 19.5% is the mid SUV, where the Vitara and Creta and Seltos play, and about 1.3% is the premium SUV sector. So combined 22.5 plus 19.5 plus 1% is equal to 43%. That is what the total SUV market is.
It's above 40. What would be the long-term implications of this big change in the passenger car market? Indian passenger car market, let's say a couple of years ago, was dominated by entry car. Now it is dominated by SUV. SUV margins on an aggregate basis are much higher than what the entry-level car margins are. If this is a major shift where 40% plus of the total new cars are being sold are in SUV, what would be the medium-term implications of that for Maruti and for the industry?
Yeah, so you're right. Larger cars generally give higher margins, but I must say that it also depends on the level of competition that you have in that segment, even if the vehicle is large. But yes, as a general principle, larger cars give better margins. On the question of the lower end cars, there's still substantial part of the market. In fact, this year they will have a growth of 20%, the hatch market, and will end up something like a 13,60,000 volume, which is very large. It will be about 36% of the overall market against a 43% market for the SUV. So still very large segment, the small cars. And we are, of course, dominant in the small car and always been. Our market share there is 70% plus. But in SUV, as I mentioned, it's a challenge because we are not the number one player in SUV, but we intend to become the number one player in this year, 23-24.
All right. Shashank, really appreciate your time. So glad you could join us. And next time we have to meet in person and enjoy the breakfast rather than meeting online and talking about butter, toast and paratha.
Paratha it will be. And It is your choice, aloo ka paratha or gobi ka paratha.
I like paneer ka paratha. You missed on that one.
Okay, so we'll try for that.
I appreciate your time. Thank you for joining us. Let's take a break. When we come back, we'll capture the market first, 30 minutes of trade and, well, nothing incremental. We've not fallen, we've not gone higher. The breadth is looking okay, but the bottom line here is that Nifty is just not going anywhere.
Welcome back to First Trades. We've got AK Saragi. He's the Deputy Managing Director and CFO at JK Cement, here to talk about the pricing environment as well as competitive intensity and much more. Thank you so much for joining in. Mr. Saragi, given that industry demand for the grey cement is looking pretty conducive, do you think that FY24 is likely to see a better pricing environment? What exactly is going to be your strategy?
So, with the increase in demand, we definitely see that the prices should increase in FY24.
So you're looking at some sort of a price increase down the line, but give us a sense as well as to what the overall demand picture is currently looking at, and what is the extent of improvement in pricing that you can see in FY24?
So, as far as demand received, primarily we are a North India player. So we see that in the north, mostly all plants are operating at 85 to 90% capacity utilization. So we, with the cost pressures and where we could not increase the pricing, there's been some marginal increase only. We see that there could be a price increase of about rupees 20 in FY24.
Okay, let's talk about white cement, because that business of yours, saw weak volumes because of, I guess, intense competition in the, in the putty segment, with paint and grey cement manufacturers now expanding in that particular arena. What are the plans that you have to strengthen it once again?
So, as far as white business is concerned, we have been growing the white segment around 7%. Yes, there is a lot of competition in the putty segment, with all the paint manufacturers entering the putty segment. So we are, because putty is part of paint, and as a next part of our next strategy, we are also entering into paint. And in fact, we have acquired a small paint company, and we shall be entering the market to begin with, our core markets in the north part, and we will see that will help the growth of the white business.
Given that, costs were a bit of a concern in Q3, the use of high-cost fuel inventory had led to a rise in power and fuel costs as well. Has this led to higher freight costs? Are you seeing signs now of fuel costs cooling off in Q4? What would this mean for your margins?
So the fuel cost has cooled down during this quarter, and but we still have some old inventory line. So part of this quarter, we will see some cost being impacted will be there for the high inventory. But going forward, we would see that the prices, the fuel costs coming down.
Okay. But is there a pushback coming from buyers on cement pricing? We understand that even in north and south, cement manufacturers are struggling to keep the recent price hike intact. They've been forced to give discounts. Is that true?
So see what happens, in the month of March, everybody wants to maximize the volume. So there is having a volume pressure. It is, we're not able to hold on to the prices. So there are some discounts, otherwise, but no major drop in pricing.
International coal prices have come down. Fuel prices are not going higher. You've increased prices. There is no pressure according to you. So are we looking at for a really good scenario or a setup for cement industry? And if I may use the phrase, "Achhe din," are they back?
Hopefully, I mean, we also feel that yes, with the demand going up and the election around the corner, it always happens that during in the election year, there is a lot of activities. The institutional demand is at its peak. The housing sector has come back, and now the cost pressure is reducing. So we would definitely, and if we are able to, get some price increase, अच्छे दिन वापस आ जाएंगे.
Can you broadly tell us the contours of the demand, residential and industrial or infrastructure? Where is the push coming from and where is the demand coming from?
So see, historically, residential housing is around 60% and it remains the same. So, there is sometimes when there is a dip in the demand, there could be from 65, it may come down to 50, 55. But otherwise, presently we see that, we are getting demand from all segments. The housing has come back. There is a lot of infra demand. So if we broadly break it up, though there is no published data really available, but if we see that, 65% could be housing and 20% may be infra and 15% may be others.
Okay. And what's your outlook then in terms of the subsidiary that you had acquired? That was Acro Paints, a 60% stake. You had one planned foray into chemicals, waterproofing, construction, etc., construction chemicals. How is it performing? What's the outlook in terms of the expansion into the paints business? And how much is it to your total revenue pie?
So, see, Acro was a small business with a turnover of around 70-80 crores. Now we use that brand, all the formulations available, and we hope that in this FY24 we can double the top line, and then make our position in the northern India going forward.
Right. Thank you for taking time out and joining in and giving us a view on how things are shaping up with KEC Cements. All right, a quick glance at the equity markets, and as things stand, circling around the 17,050 mark. But let's get a move on then, and PE firm Chris Capital, with approximately $4 billion of assets under management, has investments across sectors including KIMS Hospitals, Eris Life Sciences, as well as NSC, with prior exits in heavyweights like Infi, HCL Tech, Axis Bank, and more. Sanjay Kukreja, partner and CIO at Chris Capital, spoke about the outlook on India investments, potential for the healthcare delivery space, as well as his view on recent listings in the new age tech space. Listen in.
Fundamentally, the story is of backing growth in India, and backing some great entrepreneurs. And we've seen some great stories and winners over time, because we've been in India now for 24 years. As you sort of recounted, lots of investments. We've just completed our 100th investment actually as a firm. And we've also seen 80 exits. So through cycles, a lot of experience, through the years. And really, if you just recall back and say, look, what is the, the fundamental thesis has always been backing sort of great entrepreneurs and good businesses through cycles.
You spoke about a multiple exits, and that has happened largely within IT, Cyient, HCL, Infosys, LTI, KPIT, Emphasis. I could go on. Just walk us through, what was the strategy in identifying these companies? How long ago was it? And, how did those investments really pan out for Chris Cap?
So, so first of all, Chris Capital has always had a sector-specific approach. I think back in 2001, 2002, right from that point onwards, we've really had a focus on, organizing the firm even by sectors. So IT services was always a very strong focus area for us. And our teams are organized, the sectors were organized by that. So there was always a sector lead who was looking at IT services. I've covered it personally for many years myself, but others have too over the years. And what we were able to do with that is really lived experiences, right? Identify some of the better companies. We have had, almost a third of our capital through our, history of investments has gone into business services, the sector that you called out. and had a very strong successes in that, as you recounted some of the names. But even within that, the strategy has changed quite a bit. I think we've done, early stage deals like Emphasis and Spectrum Mine back in the day in 2002, 2003 timeframe when these businesses were scaling up dramatically, to later stage companies in 2007, 2008 like Infosys and HCL, which were, more listed in nature, and we were taking advantage of, market corrections post the global financial crisis, and maybe just prior to that as well, where we came in and said, look, some of these companies can continue to scale, and we're getting good, attractive valuation points, and that's when we made some of those investments. To 2012 onwards, where the strategy changed a lot towards moving towards US-India corridor investing. So we started investing in companies that maybe have a sort of a large portion of their value being driven by India, but the founders may have been based in the US, or the companies may have been settled, have been run out of the US.
Majority of the investments have come in from the IT space. Can you walk us through what the outlook is here? Because it seems like a lot of the industry executives indicate that it is a bit cautiously optimistic. So what's the strategy while identifying now players within the IT space?
Yeah, so I think, look, obviously there are IT services business is not, fully recession proof, right? You are servicing Fortune 500 customers. I think, obviously Eurozone is already in recession. US likely to, get there at some point. At least a lot of talk around that. And so corporations are actively sort of, thinking through their budgets, and in such environments, I think, if you divide the businesses into run the business and change the business, the change the business side tends to get, pushed back, whereas run the business is more sort of, those investments still need to be made. So you pivot a little bit more towards run the business types of companies, and because they have a little bit more surety of, growth in the next 4 or 5 years.
It seems that one sector that has been relatively unfazed, if you could, would be, the hospital space. We've seen a lot of deal flow as well that's taken place. So pharmaceuticals as well as that entire space as a whole, the healthcare services, that's a space that you as a group as well have invested in. KIMS Hospitals, Eris Life Sciences, Mankind, etc. Do you think that we are likely to see a lot more focus on healthcare, especially post the pandemic, and therefore the sector as a space looks a lot more interesting?
I mean, pharma is actually, again, one of our core sectors that we've had focus on since 2003 onwards. We've had Sanjeev Kaul, join us in 2004. We used to be president at Ranbaxy before that, so a lot of operating experience, and led our pharma investments for a long time. Today, another colleague runs it. We are obviously very prolific investors, but what we've in pharma and healthcare. But what we've done more recently is actually broken up pharma and healthcare into 2 separate sectors, really reflecting what's really going on in the market today. There is, the domestic formulations market, which is really the pharmaceutical companies like Intas and Mankind, where we've been investors for the longest of times. These are fantastic businesses, generate very high return on capital, very high gross margin, provide, also from a certainty around growth. I mean, they'll never be the companies that can grow 10x and like that, but there will always be steady Eddie growth in these companies, as they provide a critical service to India to really get Western medicine, more integrated into society, right? So they're playing that critical role, and these companies are scaling up because of that, because there's still much more room for growth in these businesses. So that's been our, very sort of dominant theme that we've been investing in over the last 20 years.
What's the outlook when it comes to manufacturing as a space? Because, experts seem to allude to the fact that India is seeing a manufacturing renaissance of sorts, and here is where all the action will be. Do you believe that there's a lot of potential? Can you walk us through some of the investments that have been made within manufacturing?
So, we've been, obviously manufacturing in India is something that is has always been on the come, right? And it's been a sector that we've always been looking and tracking at, but has also not been a sector that has delivered historically, and has flattered to deceive. Having said that, I think a lot of action has happened in the last 5 years, whether it's from a policy perspective, whether it's a confluence of global events, playing out in a certain way, whether it's geopolitics and cost structures moving in a different way in China, etc., which have created opportunities for Indian entrepreneurs. I think specialty chemicals is one area that I'd call out where it's quite clearly visible the last 5 years, the kind of growth Indian companies have seen. It's a very strong sort of success case. At the same time, textiles was a great opportunity that Indian companies didn't capitalize on beyond a point. And you look at some of the companies in Vietnam and Bangladesh probably have taken a lead over Indian companies in that sense, in that space. So it's been a little bit of a mixed bag. I think clearly today there's a lot of excitement in the space. When you talk to investment bankers, they're putting a lot of effort in covering here. I think few of them have even said, look, investments in the space may go up 10x. So it's clearly an area you need to focus on. We are at Chris Capital obviously evaluating this, constantly. And we would be very happy to see a vibrant sort of manufacturing hub sort of really emerge in India, because that will really allow for a lot more investments to come. Are we there today already where we are seeing hundreds of investable companies on the manufacturing side? The answer is no, we're not there today.
But that aside, consumption as a space as well, you all have some investments within this space with TCNS Clothing, which is a listed company. Just walk us through whether or not you're expecting, some sort of inflationary concerns to maybe play spoil sport to this space, and what is it that you're looking at before identifying the appropriate companies within this space?
So what we love about consumer obviously is the fact that these businesses are fantastic businesses. They're sticky, they're retail, they're B2C businesses. Gross margins are very high. I think the challenge, of course, is growth has been patchy historically. We've not seen runaway growth in consumer relative to, let's say, manufacturing, or clearly relative to IT or even pharma, and certainly relative to new economy. So growth has been somewhat muted. Inflation has been a concern. I think the single biggest challenge, frankly, has been overexcitement and valuations, which is why we've, not been in a place to actually deploy a large portion of the fund into consumer. We've always made investments, but they're not, as large as what IT or pharma has been for us, because we've struggled on, coming to terms with the valuations. That being said, I think, where we are seeing today, there has been a correction in valuations in this space for a while, and the time correction that I talked
about. That the new finance bill amendments and the indexation benefits for debt mutual fund now will no longer be available from 1st of April 2023 onwards. What does that mean for mutual fund schemes, and could the mutual fund schemes see a massive shift, at least on the institutional side and also on the HNS side? Sanjay Shah of Prudent Corp joins us now. Sanjay, good morning. Thank you for joining us. In your understanding, what would be the immediate implications of this starting from 1st of April 2023? Sanjay, is my voice reaching you? Sanjay, is my voice reaching you? I don't think you can hear me. We'll go back to the, our big story. But right now, if I just look at what is happening to the market, 18 points down for the Sensex, for the Nifty also, it's a mild recovery from the day's low. I think that is important. It's a mild recovery from the day's low. Right, A. Balasubramaniam, Chairman of AMFI, CEO of Birla AMC, he joins us now. And Bala, the AMC stocks have plunged. Everybody is now worried that the mutual fund industry will be hit substantially, and it's a major setback for schemes which have a very strong debt portfolio. What is your understanding of the new amendment to the finance bill, and how will this change life for AMCs?
So I think, Nikunj, first and foremost, I must mention that this new provision has come as a surprise, given the fact that there's absolutely no mention about this in the budget, whether it is related to the removal of long-term capital gain tax or the indexation benefit which mutual fund fixed income schemes have been enjoying for the last number of years. Therefore, it came all of a sudden as a surprise. There is absolutely no doubt on that. And even we never expected, given the fact that mutual fund industry play a very key role in both development of the equity market on one side and the bond market on the other side quite substantially for a very long period of time. And therefore, it came as a surprise. I also believe that the way the mutual funds have been playing the development role on the bond market, which I think is one of the most need of the hour for the country as a whole, in addition to the equity market, I would assume that upon making some representation, they may probably think about making some changes. Though right now, too premature to mention about that. Definitely is something we will remain hopeful. But I think one has to look at the entire bond market, the price discovery mechanism, and the funding of most of the need for Indian corporates and non-bank financial services. Most of the government-sponsored PSUs institutions, such as NABARD, NHB, and PFC, REC, they have been the large borrower in the market, and mutual funds have been the primary subscribers to this market, giving them money at best possible rates by way of helping them price discovery. At the same time, also the mutual funds have been playing a very large role in the government securities borrowing programs. Therefore, the importance of fixed income schemes in the country has been growing quite consistently. And from investors' point of view, this becomes one of the best asset class as alternate to any other risky assets that we may have, and continue to the large pool of growing needs of considered investors. But therefore, it came as a surprise, no doubt. And something we'll have to just see, Nikunj, given the fact that how in the new world, assuming scenario it remains, and how one has to get positioned, because asset class doesn't go away from the importance point of view.
Okay. Pala, but some would also argue and say that, look, we should not be surprised at all. This is in spirit with the fact that the government is working towards simplifying the tax regime. All asset classes, they should not be prioritized. And right now, if you are in fixed deposit, if you have money in fixed deposit, you don't get a tax advantage. If you're putting in debt fund, you get a tax advantage. Now, for a fixed deposit owner or a fixed deposit investor, why should they not get the same advantage which a mutual fund gets? And then why should mutual fund get an advantage? So it is in spirit with what it just normalizes the regime.
I argue with you. Of course, while point is right, Nikunj, I think one has to look at it, the asset class up to different things. One, of course, when you go to the fixed deposit bank, there is a guaranteed return that comes in. And with, of course, whatever the guarantee that is being given under the protection is up to about 2 lakh rupees. Above that, anyway, you run the risk of on the FD as well. But at the same time, FD as an asset class gives you a fixed return, no doubt. Whereas a mutual fund that doesn't give you the guaranteed return, the mark to market is there. But yet, because of the large component of the portfolio is an accrual nature, therefore, from investors' point of view, it gives a longer term benefit. Those who are coming to the mutual fund, they always come to the mutual fund fixed income schemes after exhausting all their options, going for the FDs and other things. Therefore, this is something need to be kept in mind, because mutual fund, the capital gain tax is coming because there is a mark-to-market risk you take, instrument that you take on a various instrument that you take. It reflects on the risk that is available on those instruments in the portfolio in terms of the valuation. Therefore, it has always been getting the tax benefit. That is one. Second is, from the bond market point of view, I think there is one of the area where there is a huge effort that is being put by SEBI and Ministry of Finance. Often they have indicated we need a vibrant bond market in the country in order to progress to the next level, in addition to the equity market. And who have been playing the bigger role in this? Mutual funds have been playing a bigger role in this for many number of years, for price discovery, drawing the yield curve, giving the money at the lowest possible rates in the market. The entire interest rate reduction that happened, the pass-through of the interest rate reduction largely was passed through the mutual funds assets, which was growing at that point of time. And that's the way the bond market got a significant benefit, reducing the cost of borrowing for Indian companies. Yeah, we became one of the alternate source of financing. And that cannot be taken away. I think it's unfair to link it to FD and other things. Therefore, we need to have uniform policy. But instruments have to be understood what role they play, and on what basis which the tax benefits are being given.
Sanjay Shah also joins us now. Sanjay, good morning. Thank you for joining us. Sanjay, in your understanding, what would be the immediate implications for debt schemes starting 1st of April 2023?
So I think definitely it's a shocker because nobody who expected the sudden change which came. But still, I think I'll reiterate that the debt funds of the mutual fund itself has their own advantage, like providing the significant liquidity. I think the basket of the instrument which you buy underlying schemes. So probably I agree as far as the tax arbitrage which was available has gone away. But if you look at the large asset which is there in the with the industry is in the bucket of 1 to 1.5 years, which are probably you can talk about the liquid, ultra short term and short term category. They were never coming to mutual fund for the tax arbitrage. So all the corporate money which used to be managed by the fund houses will continue to remain there. But yes, I think it's going to be from the point of HNIs and ultra HNIs, it might be they need to look for some alternative.
Sanjay, in your understanding, how much of the schemes, mutual fund schemes currently are getting inflows from institutional clients and HNI clients, and how much is coming from retail, pure retail?
So if you look at pure retail has not been, I'll just give you a prudent example. Today in my assets of, let's say we represent entire IFA community or the retail community, in my 57,000 crore of AUM, 92% is equity. So probably the retail has not came to date. It is always the institutional money, and institutional money where probably if you look at there is you can distribute into two buckets. One is short-term parking where they are optimizing their investments. So still I think the mutual fund is continue to remain a very good alternative. Now if the money is coming for a longer term, like if you look at the target maturity series, FMPs or the passive funds, there probably the people will start looking for the alternative. But still, if you now probably you can look at everything comes at par, right? You don't have any tax advantage. Now, if you don't have any tax advantage, still absolute return also possibility of the debt fund is very, very likely that they'll be able to generate better return.
So what happens in this case? I mean, is it a clear advantage, FDs for that matter, equity saving funds, hybrid schemes? And then I want to talk about gold as well. But first, where do you think the money is going to flow into? Bala?
Yeah. I think of course, let us assuming this what has been done, it comes. I think it's going to get implemented. Naturally, of course, the alternatives will become the hybrid funds, arbitrage funds, and increasingly people would like to take more risk in the equity itself. In that sense, of course, the prominence of other asset classes will increase. Just to also add to the point what Sanjay mentioned about while corporates have been the large investors, especially at a time where when equity market turns extremely volatile, even from retail and HNIs investors' point of view, we have been, of course, dreaming that their own participation in the bond market had to go up quite significantly as part of their portfolio balancing. And that's something would remain one of the most sought after asset class from investors' point of view. But having said that, naturally, it will give an edge for funds like hybrid funds, which has got a mix of both equity and fixed income, would actually gain more prominence. But I think one has to still keep in mind whatever the mark-to-market, the fluctuation would be there, which otherwise is there in the fixed income schemes as well. That is something one cannot assume that it will go away. At the same time, industry, of course, have to, of course, think about new way of building this business. Though at this point of time, when I compare that India versus US, and US bond market is as big as an equity market and catering to the growing needs of investors. Even recently, when, as all of us clearly remember, the recent crisis in the financial market in US, the one of the beneficiary in the US has been the money market funds who have been the large beneficiaries because they are the one have been giving the interest rates which are prevailing at this point of time to the investors compared to even the banks who have been giving the lower deposit rates to the investors. And that's the kind of role which is mutual fund have been playing, that true reflection of the market prevailing yield, which 100% actually goes to investors. And these are the importance, in my own belief, is cannot be taken away and kill one of the asset class which can play a very big role from investors' point of view, as well as from the bond market development point of view.
Sanjay, closing comments. Do you think suddenly?
No, I think the
yeah, go ahead.
Yeah, it's a sudden change, and everybody has to absorb as far as mutual fund AMCs are concerned, distributors are concerned. But one thing I can see that the less than 5 lakh rupees ticket size in the insurance is now becoming again very, very attractive. Because the exemption, only product where you get the tax exemption is the insurance. So again, I think advantage is going in favor of insurance. Even in case of above 5 lakh ticket size, also now the mutual fund was enjoying the tax arbitrage, so that is now going away. So now mutual fund, otherwise, but if you look at mutual fund has its own strong advantage as far as management, liquidity, and the credit management is concerned. So virtually, after some hiccup, I think virtually will come back for sure.
Sanjay, Bala, both of you, thank you so much for taking the time off from your busy schedules and giving us all the perspective on what this really means. A sudden move at that, and clearly you can feel the stock market impact as well. HDFC AMC is now down 4.5%, Aditya Birla Capital down 3.5%. Even some of these, life insurance plays are the ones, I don't know why, still seeing an impact. But on the other side, it's mid-cap IT all the way, which is holding out very, very smartly after Accenture's commentary. Coforge, Birlasoft, LTIM, Persistent, these are all your big winners. In fact, within the Nifty as well, the smidge of a green is only within IT. Infi, Wipro, TechM, TCS, HCL Technologies. That's about it pretty much. But Kunal has been spotting some other breakout candidates, which we will address after this very quick break.